Hi, Norman Howlett here with your next 4-minute drill for traders. In our last drill, we talked about how George Soros and Warren Buffett both have exercised the same cardinal rule: don't lose money. But how can you make money if you're not willing to lose any money? Of course, what they mean by don't lose money is that not losing money should be the #1 priority, knowing that from time to time you will be wrong in your investments and you will lose money. But the idea is to make sure the money you lose is a very small amount compared to the whole and compared to the potential you could win. To my knowledge, for instance, I don't remember Buffett making a play on any startups. He sticks to companies that have strong balance sheets and have proven assets to take them strongly into the future. He looks at management. He looks at revenue. He looks at profit history. He looks for growth. He lines up all the facts on his side before he makes a move. And when he makes a move, he makes them only if he sees a much higher future value, where he believes that based on the numbers and the growth direction that a company is way undervalued. Again, he puts a strong foundation on his side and then makes a big play, knowing that he could lose 1 increment, but could make 10, 20, 50, or even 100 increments in return. Do we do this when we trade? Can we do this when we trade? Can we measure all the things that we can do to give ourselves the highest possibility of success before we enter a trade? Can we find stocks that are very low in price compared to their true value and then watch for strong technical indications to make our moves? Sure we can. Can we discover seasonal tendencies in a commodity and then watch for technical triggers to put us in the direction of that seasonal strength or weakness? Sure we can. Oh, and did I mention the word patience? We all say to ourselves that being patient and waiting for our ideas and our technical reads to develop is an important key to overall success. But nobody would agree with you more than Buffett and Soros. So why do some of us scalp the market, for instance, looking for knee-jerk moves of emotion to make money rather than trading in a way to let a trade or an investment develop based on that foundation we talked about, where measured truths and seasonal tendencies can take hold? So I pose to you scalpers, can you somehow justify your trading style with any reasoning other than scalpers are in and out of the market quickly and that reduces the risk because you don't have much exposure, you're out of the market more than you're in? What do you think Soros or Buffett would say to that? Let's hear from you. Look, I've done plenty of scalping in my years of trading, and I have my defenses, although I'm not so sure they make much sense after studying Soros and Buffett as I have lately. But what do you say if you're a scalper? Let's have a little rapport here. The more I read on Soros and Buffett, the more it makes sense to be the turtle and not the hare when it comes to investing. Take a chance and leave a comment. Okay, that's it for this edition of 4-Minute Drill for Traders. So until next week, you know what I'm talking about. Stay disciplined.